Hey, 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 everybody. Welcome to another edition of Trading Virus, Stonks, and Crypto with your host, The Bear. And we've got Jamie co hosting. I mean, you could be the host if you want. I don't have to be the real host. Like, I'm just the jokester anyway. And then we got Warwick on the call with us, too. It looks like he might have pushed Tom in the river, which is why he's not with us. I heard the two of them enjoyed a nice walk out in outside.
He's probably prioritized the Chinese, to be fair, and I don't blame him. Like, Chinese food. I probably should clarify we were talking about Chinese food. Yeah,
of course. We have a packed show for you today. We're actually going to stick to an hour. I'm cutting it off at 3 p.m. Eastern. We're officially done.
Sure you are.
I mean, it's nice out, man. I want to go out for a bike ride. I want to socially distance myself in the best possible way, exercise. And it's especially good because I don't know about anyone else listening, but I haven't worn deodorant in many weeks, and I don't need people smelling me right now. So let's jump right in here. Let's check in. Actually, let's check in with everybody. How's everyone doing? Let's do our weekly welfare check-in. How are you doing, Jamie?
Man, I'm good, to be fair. I've had a pretty good week. It's been nice weather, to be fair, in Blighty, so can't complain. Still on lockdown because I'm not in England, so yeah, nothing much changed. Lots to been watching from the market. So much has changed from a news perspective to then obviously try and counter that into the portfolio, and then that's about it, to be fair. Same old. Yeah, all good, mate. All good.
Cool. And you, Warwick, how are you doing?
Yeah, keeping pretty well. Staying out of trouble. Keeping an eye on the markets is interesting. It's nice time to be watching things. Bit of volatility gives us opportunities to make some money. So.
Yeah, absolutely. We'll go over the paper trading account that I started last week is looking pretty good, and it actually saved my positions unlike Interactive Brokers. So we can actually review some of the positions from last week, which that'll be part of the show. And feel free, either of you, to cut me off because I seem to have a gift of gab and just bullshitting my way through everything. So don't be shy. Feel free to jump in. All right.
Sounds good.
I guess I'm doing well. I've got a newborn that decided to sleep through most of the night last night, so I actually got a pretty decent night's sleep. And that was good, and it's beautiful out here. Like I said, heading into the end of spring, early summer months. This is my favorite time of year. Not too hot, nice and sunny, and the hormones start to surge. I don't know why I said that. Let's jump into Let's start with our disclaimer. Jamie, you want to take us away here? Absolve us
of any wrongdoing? So yes, this presentation is for informational and educational purposes only. The material provided should not be interpreted as investment advice, an endorsement of any stocks, ETFs, futures, options, currencies, and cryptocurrencies. And I'm sure everybody else can read the rest in their own time. I think everybody gets the gist of it. Yeah, same old. As normal. We're not actually having whiskey today, so we can't actually say that would be immature. We're just immature anyway. So yeah, I mean, I've got a brew. I've run out of whiskey. I probably should order some more. So next week, it's got to be on.
Yeah, I also have not replenished my whiskey stock, and I'm not drinking either. So this will be a sober show, which means we'll actually stick to a nice schedule. So should we start talking about, we usually start off with the virus. I mean, we don't have to check in with the case counts. I mean, people are reopening. In my opinion, this is a terrible idea. The virus is going to come back. People are intermingling. They're going to spread this thing around. The CDC came out with some bullshit guidelines for businesses to start opening up. That's all fine and good until one person sneezes the wrong direction. And the other thing, I went to the supermarket yesterday. You have to wear a face covering whenever you go inside. And these idiots are walking around with the face mask just covering their mouth, and they're letting their nose poke out. So what the fuck is the point of that? It's just like everyone, it's insane. I don't know if you guys have that in England there where you are supposed to wear face masks indoors, and if you see the blokes running around not wearing them properly, is that...
Yeah, I mean, to be honest, like I don't know about where Warwick is, but I mean here, even though we're supposed to be on lockdown, there's loads more traffic since Wednesday. So Wednesday was like the official time that people were starting, like basically the government was easing for people in England. It was supposed to be for the UK, but basically the Scottish and Welsh and Northern Ireland Irish government have basically said, no, we're going to stay in lockdown for now. So it's a little bit different depending on where you are in the UK. But here, yeah, it feels like people over the last week have started to become a lot more relaxed now and kind of let their guard down a lot more, which, I mean, you can kind of understand, I suppose, up to a certain point. But yeah, I don't think people are being, I mean, some of the videos that I've seen, like in London, for example, in London, it looked terrible. Like buses absolutely crammed filled with people, and then they're just all leaving as if it was like a clown car with about 1,000 people leaving the bus. So, I mean, things happening, let's say in villages or small towns, I think they can get away with that a little bit more because it's not as densely populated. But when you start seeing things like that in cities, that definitely raises so many red flags, which obviously you don't want to see. So, as you say, time will tell whether a second wave comes or not. I don't know. What about you, Warwick? What's it like where you are?
So yeah, kind of similar. More people out and about, I think. Though I'm kind of I'm in a town probably about 40,000, 50,000 people, so it's not massive. Yeah, noticeably more traffic, but at the same time, you still got quite enough of a police presence. I just went for a walk around the kind of the local park. Ordered a coffee, which was really nice actually. But there was, yeah, it was nice. Sat in the sun, on the weir by the river. It's really quite nice.
Oh.
Yeah, you did have the police kind of driving up and down. Still, there was one cop car just to kind of, try and put a dampener on things. But it is what it is. Feels as though something's lifted a bit. They've taken the tape off the bench so people can actually sit down on them, which is nice, isn't it? I suppose.
Lovely. It's always nice, but yeah, I don't know. I think I've let my guard down too much because we had like not in terms of the virus. I just mean in terms of traffic because there was literally hardly any cars on the roads up to a week ago, and then I've got used to going for runs and just not bother looking left or right. I'm just like, well, the car can stop. There's not going to be many of them. So, and then today I go for a run and then a car goes crazy at me. And I'm like, what, fam? I'm like, you shouldn't be driving anyway. So, yeah, I probably should start looking left and right now before I hurt myself. It's not because of the virus.
Yeah, COVID takes over and gets splacked by oncoming traffic.
Yeah.
The irony.
But, yeah. But I mean, in terms of virus, I've actually started looking now at cases, but then looking more at the rate of change as well, because I mean, as Thomas says, I mean, there's so many grains of salt with looking at the data when it comes to cases, but I'm still keeping like one eye on it anyway. Am I still screen sharing? So I mean, yeah. I've been keeping an eye basically just on two places. One was Germany. So Germany opened up little by little on the 20th of April. And then, I mean, just looking at that graph, so basically in orange, you've got the daily new cases, and then in blue, you've got the rate of change. So really what you want to do is that you want the rate of change to stay below zero more than anything. But it looks like, as you can see there, that Germany, even though it's been quite a while now, so I mean, we're getting close to a month since Germany started opening up, you're still looking at lower highs, which is the thing that you want to see. So hopefully, fingers crossed, it won't get to the point where we'll have a second wave. But then if you want to see on a place that looks a little bit suspect, again, we have to take it with a grain of salt. But then the other place I've been looking at is Texas, because they've it feels like they've been pressured into just opening really quickly and being the guinea pig for the US. So looking at Texas there, so it's the same dates from the 20th of April all the way to present day. But then you've got the gold line in the middle, which is basically when they've opened, which was on the 1st of May. So just looking at that data there, on the 13th, we actually got the highest amount of new cases. Again, you have to take with a grain of salt because there's so many more preparations in place for people to get tested, blah 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 blah. But I still think it's something that we definitely need to keep an eye on, because I mean, even just looking at it as a TA thing, if it starts to go to all-time highs and we start seeing W's, etc., then we still, this could influence the market if there is definitely a case for a second wave. I mean, I've got family who work in hospitals and they speak to consultants, and it's more of an opinion from a consultant's perspective, I think, at least, from what I've been told. But I mean, they think that because the amount of people that they're going to start lifting things now quickly, and it is because of economical reasons. Let's be honest, it's not because of, there's not as many cases now. It's because of economics. They're scared that everything's going to dump to shit. So they think that people are just going to do things willy-nilly as normal, which wouldn't surprise me. I mean, even I'm seeing that now. I mean, we're supposed to still be on lockdown, and the park next to me is definitely like 10 times more people than there was a week ago. So they actually think the second wave might actually be worse than the first wave. Whether that happens or not, who knows? But yeah, I don't know. In terms of, I'm still keeping an eye on things, because at the moment, with the correlation so high just with the S&P, I mean, at the moment, everything's correlated to 1. So for me, there's definitely things that have decoupled that shouldn't decouple and should go in unison. So, I mean, one thing is like the VIX compared to the correlation, and there's a massive gap between where the VIX at and where the correlation is with the S&P and the rest of them, and with the market. So there's something not quite right, and it's all down to sentiment. So if this is something that could turn sentiment quickly, then I could definitely see another leg down, depending on how severe it could be. So yeah, that's my stance on the virus anyway.
Quick before I think it would be really cool if you overlaid on top of those new cases and COVID graphs, if you could do the number of tests, because I think that in some instances they're testing. What's that?
I'll have a look at the data. I didn't realize I could find the data on that. I'll have a look. That's a great idea.
There are some states that are publishing the number of tests that they're doing per day, and some states have actually decreased the amount of tests just to get their data to look better. Like, we used to get pissed off in China. Yeah, I mean, like, China. Back in January and February, everyone was livid because China was manipulating all their numbers, and here we are doing the same fucking thing as they are. And it's just like, things are getting so much more complicated with the politics of the virus. It turns out that if you follow the money trail, you can see that the department that Dr. Fauci was from funded some of this gain of function research that was taking place in the Wuhan laboratory. So the United States funded the research. China fucked up by letting the virus out. Who's to blame? Both of them are pointing the finger at each other, and really both of them are to blame. And what I'm really concerned about is a U.S.-China war, which it seems like this is escalating to. And
don't jinx it.
Yeah, I know. So, I mean, that's as far as I want to go as far as virus talk. I think there's a lot of things we got to cover in the market. So, do you want to keep going? You seem to have some momentum. Do you want to talk about some trades or what you're seeing market-wise?
Market-wise, I mean, in general, there's obviously a lot that have gone on, depending on where you are geographically. I mean, a lot has. I mean, I don't even remember half the things because the amount of stuff that's come out. But just to quickly talk about things, I mean, if you're UK's perspective, Brexit negotiations have been carrying on. So today was, there's not many meetings left now in order for people to start deciding on what steps the UK is going to take. But the UK have basically not budged to the EU with what the EU want to do. Whatever your bias is on the situation, it's obviously not good for the UK economy in terms of, short term, or maybe depending on what the outcome will be, whether we do have, an orderly Brexit or not. But, thinking of it from trying to hedge yourself in this game when it comes to currency, I mean, having the pound, and with so much going on at the moment, I think it's always good to, put yourself in a position where, if the pound does drop, goes very volatile very quickly, on top of what else could happen negatively, then the pound is obviously going to suffer. I mean, we've seen that over the last couple of months. So, yeah, from that point, I've just been looking at that. They've basically said that they're not budging. The UK and the EU aren't budging as well. It's a two-way game at the end of the day. If you want people to, dance tango, then both the man and the lady have to do well. So yeah, from the Brexit front, that's that. Then in terms of so I mean, I was listening to a couple of podcasts over the last week, and just to get a sense of figures in terms of what institutions are estimating when it comes to debts with the central banks, etc. So and interest rates. So one, I think it was TD Securities, what I was listening to. They're basically estimating that by the end of next year, you're probably looking at the Fed's balance sheet being at around $12 trillion. That's what they're estimating. So the end of 2021, which is crazy. And then at the same time, they're not actually looking at, say, if, all of this, with everything that's going on at the moment, they won't expect any hiking, so the interest rates and going up until 2024. So obviously these things are really, difficult to estimate, but it's always good to know where the smart money, what they're thinking, because it's when the markets change is when then obviously they start thinking about things differently. Or so yeah, in terms of that, with the central banks, of course, let's see what they're going to get up to even more. What they've said, one of the famous things that he said is, I think I have some more information of the speech that Powell gave not long ago. Jesus, so much has gone on.
Yeah, while you find that, I'll interject and say that, the ECB had a similar outlook on negative rates. They really didn't want to go negative at first. And what ended up happening was the market just priced in negative rates and they had to go along with it. And right now we're seeing the beginning glimpses of the market starting to turn down and looking like it wants to price in negative rates. And that is what's going to eventually be what forces the Fed's hand. Like, for instance, today, did we go negative that day? On the 8th of May, we went almost to zero on the 2-year, and then I think the 3-month might have gone. Where is it? Yeah, but did you find the data you were looking for from Powell?
Yeah, so I mean, the main things that Powell spoke about, the main things that stuck out to me was basically the main thing that everybody wanted to hear. So more policy help, they'll basically be there, so they'll do anything it takes. And another thing, reiterating that they don't want to go into negative rates, like you're saying. But then one stat jumped out was almost 40% of those households making less than $40,000 a year lost a job in March. So 40%, which is crazy. So I think in terms of expectations of whether the markets are going to go up and down, like we spoke about last week, if you think the market's going to go down, you are fighting the Fed, yes, but that's in the current environment. If expectations are differed in the future. So the way I mean that is, my personal view at the moment is that the markets have basically priced in for the first 2 quarters to be really bad, and then the third quarter to be a little bit better, and then the fourth quarter to be really good. Now, in terms of expectations, like from a fundamental point of view, the reason why you're looking at specific stocks, etc., you're looking at like the next 2-3 years of the company's earnings, revenue, all the different metrics necessary when you're looking at the balance sheet. So I think the way, in order, if you want a really good leg down, nobody wants a leg down, of course, but people do like a good bargain. But I think in order for that to happen, I think you might start getting the expectation where the institutions are now possibly thinking that they need to downgrade estimations for the next year. So what I mean by that is that, as I said, they've already got estimations for companies for the next 3-4 years. But if they think that all of this is going to creep into next year, then that means that next year's earnings have to be downgraded, meaning that the price multiple that you're going to be paying for the stock at the moment or for next year is going to be basically a lot more at these prices. So this is where I think it comes down to the consumer. So when things start opening up, if consumers aren't spending of how institutions are expecting the consumers to spend, then I think you're definitely going to be getting a leg down. And I think that's the way it is at the moment, because with the uncertainties and not 100% on what the data is going to come out like, the Fed, I think, can keep things the way they are at the moment. But then once we get real data coming out, a full month's worth of data, knowing what the consumers are saying, and how much they're spending, and really understanding how many people are going to be getting unemployed and with bankruptcies, etc. That's then where the market is going to decide personally. So as soon as they start getting an inkling of how those situations are going to turn out, is then going to decide on whether we're going to go up or a really good leg down. So yeah, it's really difficult. Like, it's so uncertain. I mean, I think the last month has been harder than like this quarter has been harder than the last quarter, simply because, you know, the amount of depths that the Fed has gone into to try and move this market and just to keep it sustained and trying to work out what's going to be going on. It is very difficult. So, I mean, yeah, so until we get that data, it's very difficult. So yeah, that's the way I stand on the markets anyway.
Okay. Are you trading anything specifically this week, or just kind of the same positions?
Yeah, well, same positions. So I mean, for people who don't know, I usually do anywhere from a month onwards. So I'm not short term. I'm a lot more medium term, let's say, or even long term, if obviously the trade is working out very well. So at the moment, I'm only basically buying a stock if it gets to a valuation that I personally think will do well over the next year, because you can't really estimate what earnings are going to do for the rest of the year. So unless I can get a company that fits all the right attributes that I want in a stock, so, you know, no debt or hardly any debt, really good credit ratings, looking like good earnings over the next few years, and depending on the sector as well, because of everything that's happened, and trying to take into account of how consumers are going to be different in the future, which is going to happen, then I will go longer stock. But at the moment, I'm literally, I mean, on a Bitcoin stock, I took some profits last week, sorry, and then I'm just short at the moment a small, a position on CACC, which is the subprime auto loan company that I've basically, I mean, I was short and then I took some profits a few weeks ago, and then I've gone short again because it's come back up. So yeah, in terms of that, that's about it. So until we start seeing more data coming out, or if we do get that leg down and it gets into valuations that I really do like, then I'll start getting stuck in. And then there's a case as well that I'm watching is stocks that have done really well during lockdown, ones that have gone into crazy, you know, valuations. So a classic one would be Zoom. So, I mean, depending on when we get out of this, the way it's priced at the moment, if you look at the stock fundamentally, it's like valued so much higher than anything else in its sector. And the question there is all these companies that have done well, how much are they going to be able to retain people? Because at the same time, you're not going to chat to your mate on Zoom anymore, or your family, are you? You're going to go out and meet them. So whether they can sustain the demand, that's all priced in. So I think there'll be some good cases of being able to go long once we start getting the data out, going long some companies that have basically been killed, but definitely do have a future because they've got a strong balance sheet. And then I think that you got a case where you could do cross sector spread trade. So basically going long those types of stocks and going shorts stocks that have done really well during this, but, you know, have the valuations gone one step too far. So yeah, so that's about it for me. What about you? What about you, Mr. Bear?
I like a lot of these names that you mentioned. I just think they need to pull back first. I think the market needs to sell off. I don't know when that's going to happen, but we've definitely positioned ourselves for that in some instances, and we'll continue to do that. But let me just go over two things. One is the U.S. Department of Labor reported Tuesday that food prices jumped 2.6% in April. That's pretty ridiculous. We haven't seen that happen in 10 years. The last time we even jumped was back in 2011. I mean, that's no surprise given that a lot of these plants are shutting down. The cost of production is going up. The workforce is thinning out. There was a big article published about, I don't remember who it was by, but published about how these meat companies are basically cesspools for breeding the virus, and workers are being exposed unnecessarily to terrible conditions. And even when this first started, they weren't allowed to wear masks. I mean, this is fucked, right? Food prices are definitely going up. I noticed it at the supermarket as well. This is going to be a problem for a lot of people who don't have the same amount of money coming in. So with that, I don't think there's a trade per se on the table for like any of these specific companies that I would play directly, but it's certainly something to keep in mind and something that I will toy around with into next week. The next thing here is U.S. industrial production has also plunged. No surprise, no one's going to the factory. Things have definitely come off here, and since the last time was World War II and the Great Depression, capacity utilization has come down, and this is also a comparison of the Dow versus the U.S. industrial production. So we're just seeing signs of slowdowns. This should impact GDP. This should impact other metrics. I mean, it's just all across the board, things are fucked. Here's the Fed balance sheet that Jamie was talking about. Just in the last couple of days, they have increased the amount of money on it. We're now sitting at $6.7 trillion. And Jamie said they were going up to 12 trillion, I think.
So I think it's DG Securities. They're estimating 12 by the end of next year. Yeah, so
great.
Nearly double that.
It's crazy. They're going to continue to pump as much as they can. Anyone who knows who Stan Druckenmiller is, he gave a fantastic interview at the New York something or other, the New York Economic Council. And anyway, basically, this guy, probably one of the more famous guys in the entire space, made a ton of money. Very brilliant dude. Anyway, he came out and said that basically he doesn't believe the Fed has your back. For the longest time, the guy, his core principle in investing is to follow the liquidity from the Federal Reserve, because that's what drives markets. And in this case, he said, you know what? They've used that card. Yeah, exactly, Tony. Soros' right-hand man used to manage a lot of his money. There's a great interview talking about how he has fucked up over time and what he's done over time and how he's made mistakes, specifically during the dot-com boom and some of the tech booms, chasing the market and losing billions of dollars just overnight. Great guy to listen to. I mean, talk about having battlefield stories. This guy is, I mean, whatever he does, he makes ripples in the market when he talks. Yeah, exactly. He got burnt in the dot-com bubble at Warwick. So this guy's basically come out and said he doesn't think the Fed has anyone's back anymore, and that they've basically used their ammunition. He doesn't talk about why, which I think is important to try to understand the fundamental driver behind his reasoning here. But I think it's as simple as, the Fed's going to throw everything it can against the wall and hope that something sticks. And I don't think that that's a policy that works when you have an entire world's economy on the brink of shutting down. So, I mean, fundamentals aside, let's keep that at the extent of the conversation, and let's try to dive into some of the positions and things in the folio here. So this is the paper trading account. We put on the Starbucks puts, the $70 puts we bought into July. It looks like we paid $2.39. They're trading at $3.10 right now. So we made a cool 560 some odd dollars so far. Let's take a look at a Starbucks chart and see how we're doing. Actually, before we do that, let's just look at the S&P. Let's look at the broader indice, because I think the hardest thing to try to understand here is, when is this going to break down? That's anyone's guess. If you know, please let me know and sell me your crystal ball subscription. I'd be happy to join in on that. Or perhaps you have a quantum, right? Perhaps you have a quantum computer that's able to predict the future using that, but you have to be very careful that that's our reality and not the multiple realities that quantum computer could potentially be predicting through. All right, I've sidetracked. Anyway, S&P here looks like it was breaking down yesterday. I mean, my portfolio started to look really fucking juicy yesterday, and then we got bought back up. And I think that's kind of what we're seeing. The biggest problem from today is we've got options expiration, a lot of gammas running off the table here. I think that next week we're going to really see what the market wants to do. It's anybody's guess at this point, but I think it makes sense to be positioned to the downside. I don't want to have too much risk to the downside, because the problem with buying options is that this thing could just go sideways trading for, the next probably month or two if it really wanted to, and you just get, I swear to God, I will get this to work one day.
Yeah,
Bars
I think
pattern.
as well with like long-term, I mean, when it comes into these environments, these long-term moving average as well can get quite juicy. So, I mean, In terms of long terms, I've been looking at the 200 MA, EMA, and then the 50 MA and EMA, and we look like we're getting into the sandwich at the moment. So when these things do happen and you have price correlated in between these moving averages, they have to basically play out of where we go next. So yeah, I think we're basically, it wouldn't surprise me by the end of next week, we will probably know whether we're going up or down. I can't see, it's going to be difficult, but all you'll need is a little bit more of a spat between the Chinese and the US over the weekends. And I think this is where, in these environments, is really difficult. And you've, like you say, if you're gonna go to the downside or the upside, whatever you're, whether you're net short or net long, it's really difficult over these weekends in a volatile environment. So yeah, I mean, I thought there was a nice little head and shoulders playing off there on the daily. But then, yeah, as you say, we've bounced back, and that's in terms of the moving average. So the 50 EMA, it's trying to keep on top of that. But I think if it fails, then I think, could be quid-tin.
Yeah, I mean, I think what drives this market down is something that you and I can't predict. I think it's going to be an event that everyone's like, oh,
Definitely.
fuck, we're screwed. And that may be war with China at this point. I don't know. But from a technical perspective, you take your fibs. We went right into 61.8. We've tested it twice, and we've rejected. This is the 200 MA. I still think that this thing needs to fuck over more traders, but I could be completely wrong. Again, the problem with positioning yourself is you run the risk of being theta burned. That means losing the time value of the option. Right now in this paper account, we own the June 19th 275 puts, which I paid 548. Those are worth 732. I think that when we fired those off, the market was kind of testing that 3,000 level. So we've made money because of that. But the problem will be as if we go sideways. And the other thing that's made us money on this position is the implied volatility. Vega's also gone up because the VIX has spiked. So we're going to make money on that as well. So any kind of downward movement, especially a quick one, we will make a lot of money on this position. Now, going into June, like end of May, I may have to start getting a little fancy with this position. But right now, I'm happy with it where it's at. I'm not going to fuck around with it. I'm not going to sell any premium. I think that's just, there's too much uncertainty going into Monday. And I have until June, so I can mess around with this for another couple of weeks. So I'm satisfied with the SPY position. We've made 714 bucks on this, putting out, I think it was like a $2,000 position. We had 4 contracts at 548, so a little over $2,000. I wish this thing showed my total cost. I have to mess around with this. Anyway, that's the SPY position. The Starbucks position is the next one. We own the $70. Look at this. This almost looks exactly like the last chart. If you blindfolded yourself and didn't see me switch, you'd have no idea that there's a difference here. But Starbucks has the same thing going on technically. Actually, the SPY looks a little bit worse than Starbucks here. But nonetheless, I think this has been a position that I've been trying to fire off for a couple of weeks. I have it in my personal account. I've had it in multiple trading paper trading accounts that it keeps getting lost. And finally, we have it. It's the July $70 put. We paid $239. It's currently worth $3.10. We're trading at 74 bucks, which is quite the recovery from yesterday. We were at I think we hit $70 to the downside. Yeah, 70.65. But downside targets, you can see 61.8 down around $60. We would make quite a bit of money on this position. And in fact, I think today is a very good day to be putting on this position. If I had another account, I would be buying puts on this as well. I think it's a great position to put on, because if you don't want to play the S&P because it's too expensive, the Starbucks position is a little bit cheaper. And you might even be able to we could talk about how we did the silver trade, but you might be able to do a debit spread on this to the downside. That's another way of playing this. But right now, I'm very happy holding this position as is. Now, the next one is the Scorpio tankers. Boy, I got really sucked into this guy's Scuppy and his shipping tanker narrative. Right now, it seems like that trade has been washed out. This is luckily I bought this thing out to I have it in October in my personal account. It looks like I have this until June. Oh, you know what I did? I bought the shares. So here's how I hedged out the risk. I didn't actually hedge out the risk, but I essentially tried to minimize the amount that I paid for the shares, right? So I bought 500 shares at 1945. We lost $1,200 on that. And then I sold 5 puts against those 500 shares, and I took 75 cents of premium. So I took about 75 bucks times 5. So that's about what, $450. That's really not enough to offset these losses. And then if this thing keeps tanking, I may have to swallow this one and buy it back before things get too crazy. But I can imagine, and I saw some insider buying of this. People were buying at 17 bucks, but we're trading at 16.76. Draw some fibs. We're right at 78.6. Do you have the balls to step up and buy? I am done messing around with this thing, but I think that this might be a very acceptable level to take a bet, knowing that there still has to be oil that needs to be stored going forward. But evidently, there is a nuanced trade using time spreads on the oil market where they are basically able to sell June contracts and use that as a short-term storage option. I don't really completely understand that, but that seems to be the reason why this trade isn't performing right now. So Sting is what it is. We may have to make adjustments next week, and we can cross that bridge when we get to it. If you want to take a small position, I mean, I assume that things on the options market are probably pretty good because we've come off quite a bit. So take a look at Sting I wouldn't be buying June right now. I'd probably go into the October. Like the $20 calls are, I mean, they're still pretty expensive at 330. Vol has come off quite a bit. Oh no, that's the problem. Implied vol is still way too high, 100%. I mean, you can't play this. If you want to buy the stock, that's fine. If you want to sell some puts down below, maybe the $10, could probably sell the June $10 puts. And I mean, is that worth the time? I don't know. Let's just leave it at that. The next position is our silver. That seems to be the big winner of the position so far. I really like how this thing has popped. We paid, we did the spread here. So we bought the $15 calls. We paid 55 cents for them. They've almost doubled. They're 96 cents right now. And then we sold the $17 call against that. So obviously we're performing quite well on the $15 call. The $17 call is our hedge. Sorry, not our hedge, but that's what reduced our cost. Going into June, this thing is really starting to take off. I'm getting a little bit antsy holding this thing. I think we might be able to wait until next week to make some adjustments. But I would almost feel more comfortable paying up a little bit and rolling this thing into something like a higher strike. So let's just say we do the June and try to put this at like a $19 position. Let me see, we've got this 17 calls. So maybe if we rolled into the $19 calls, we pay, is this right? These are 11 cents. So we wouldn't really be paying up that much just to, we have to buy them back, I see. Yeah, so this might be, let's just do that now. So I'm gonna create a rolling order. So I'm gonna sell this thing, and then I've got the June 26th weeklies that I would be selling for 5 cents here. What did I pay for these things? 18 cents, right? So I would be losing 13 cents per option, which is fine, right? We already have a really nice profit in here. I mean, let's just look at the silver chart just so you can understand what I'm thinking. So I'm concerned about the upside, right? At the $17 level, if this thing breaks above that $17, the upside basically gets capped out. And the more we go above $17, actually we've kind of capped it. So it's actually a pretty nice position. So the 15 to the 17, and if this thing really started to rip above $17, then we have to get a little anxious. So maybe we can leave it for now for this week because we're at 15.49 right now. I mean, for this thing to jump, what would it be? Almost a full $1.50 to the upside. I mean, that's not outside the realm of possibilities. You can see this is like a really nice gap upward. You've got 200 period moving average. This is really the profit taking zone. I would probably start to make more adjustments next week. So let's cross that bridge next week, see what silver's doing. The position's doing really, really nicely. I don't know if anybody took the synthetic position on silver with the 0.8 to 0.9 delta, but we were talking last week about the June $12 calls. Those were priced at like, I think they were $2 because we were at 14 something. So they maybe were $2.66. Those are now $3.50. So you would have made about a little less than 50% on the position. And so far on the way that we did it, the conservative way, I mean, we've done quite well for ourselves as well. You know, our P&L for this position is about $1,800, and we outlaid probably around $2,000, I believe. So this has done quite well as in addition to that. I don't think it's too late to get into the synthetic position. You can still, as you can see, buy that $12 position, and it's trading at almost 0.96. I mean, that's going to match pretty much dollar for dollar for this thing to go up, and you can get some nice leverage on this and get yourself some more upside exposure for, right? This thing's costing you, what is it? $96 a contract, or sorry, $350 a contract. So, I mean, it's still very affordable to get the upside on this. I'm not opposed to even just putting this thing on now, just to continue capturing, right? This thing's gapped upward. Is this thing going to come back anytime soon? Well, let's take a look at things like the gold silver ratio. Gold silver ratio. Is it at the PHL or something? I guess there's this GSR. We could use that. That's not going to be too good. What do you guys remember the ticker for the gold silver ratio? I could have sworn it was the PHX. I guess I can just do gold to silver, or XAU, USD, XAG, USD, and then divide this out.
I think you can just type gold silver.
Well, okay. I guess this works too. So you can see back in March, this thing was at an all-time high. Now it seems like this ratio is coming back down to 100. That's why, you know, the higher silver goes, the lower this goes. And obviously, the more sideways silver goes and the higher gold goes, the more you get something like this peak here. This, to me, is very, very telling. We haven't seen this thing really form any kind of structure in a long, long time. This has gone sideways to up. And now look at this thing. This to me means silver is going to start performing. You need to get silver exposure. If you don't have it now, you're really going to regret it. If you're kind of on the fence about it because silver is broken up and, you know, I don't buy up markets, I want to buy things when they were low. Well, you know, we've been talking about this forever. I mean, I'm a gold silver freak just from the way that my business is. I've got my finger on this pulse, and silver demand has actually slowed down, and go figure, because this thing's starting to pop again. I mean, it's hilarious to watch how the public seems to be ass backwards all the time. Nonetheless, this thing's hitting from where it broke out. You can see maybe we should use this as our low here. 100 would be a reasonable expectation for this thing to go to. And then if you bring up that SLV, again, this is the ETF, not the underlying physical. You know, you buy this, it's not the same as owning the physical, which I believe is the smarter idea. If you don't own physical silver as part of your overall investment portfolio, I think you need to think about why you need to do that alongside gold. But, you know, for the longest time, I really didn't think silver was going to outperform, and now it is. So we have to ask the question, why is that? Why is silver suddenly peaking? We're not going to find that out, and I can't tell you. I don't know why it's decided to do that. Maybe it's because gold has performed for so long. People are looking for yield and basically trying to make money in a market that has been overwhelmed and overshadowed by gold, and silver's kind of like, okay, time for your little brother to catch up and grow up. That could be what that is. But at the same token, gold is also breaking out, right? We're making new highs here. That's bullish. So that the SLV position is, first of all, one trade that I really, really like. The second one is something that I wanted to toy around with you guys live, which is this GLD. This is the gold ETF. This has started to pop as well. I think it's a good idea to own some upside exposure on this as well. Whether you buy the underlying shares, whether you want to buy out of the money calls, whether you want to buy a synthetic position that tracks the movement of the price. There's so many different ways of doing this. So right now, I mean, upside projections, just to a 38.2, this is kind of your first target, 167. And then inevitably, you're looking at a profit taking area, 171 to 180. I mean, that looks pretty juicy. These Bollinger Bands have started to open back up. I mean, the moving averages never really look. I mean, the technical reasons aside, the fundamental reasons are also strong. Seems to be a lot of people that are very worried about gold making a pullback because it's just gone too far too fast and all the smart money has already gotten in. I mean, could this simply be a pop the top and drop setup? It's possible. If you're worried about that, but you want to also play the upside, we can kind of look to see what that, how to stylize that. So let's just go take a look at the GLD. And I don't know if I'm losing people here. Nathan, Nathan, you're a big gold guy. Are you playing gold at all? So let's take a look. I'll wait for you to chime in here. Nathan and I always talk about what's going on in the gold market. I'm hoping I'm still connected. Can you guys hear me?
I can hear you.
Oh,
I think
okay.
you're all good.
All right, good. So June, I would play this into, so where we are, May. Yeah, I mean, like a short-term play to the upside would make sense. And by the way, we're going to leave the silver the way it is for now. We're just kind of capping. Okay, good. Thanks, guys. It seems like the YouTube delay is like maybe a minute. Anyway, we're going to keep this position in SLV the way it is. So I don't want that right now, but we are capping the upside if it does break above $17, which is fine for now. If this thing continues to show strength, we want to remove that so that we can continue, or we can just adjust the position to continue capturing the upside. That'll be something we can play around with next week if need be. Okay, so GLD, we're trading at about 164 right now. The June contract, I mean, if we were to buy something like a synthetic, a 0.8 is the 154. That's $11. I mean, it's not cheap to be playing that. You could buy one contract that would cost you $1,140. So yeah, you could play the futures market too. That's going to be beyond the scope of what I do, just because I've heard a lot of horror stories from people in my business playing the futures market. And I'm very concerned about things like risk when it comes to a broader market sell-off causing massive margin calls. And that would be an unlimited risk on the futures market, like we saw back in March, where a lot of people had margin calls, had to sell off gold. That cascaded to causing more margin calls. That may not be my cup of tea right now. So, oh, see you later, Warwick. Thanks for coming on. I guess I missed that 8 minutes ago. All right, how do we play gold? You could play the 165s. These are out of the money. These are trading at about $4. I mean, these are still kind of expensive. Implied vol isn't too crazy. I mean, look, everybody's playing this to the upside. Is this a crowded trade? It's a good question. I mean, I still like the idea of trying to play this. From a technical perspective, you have all the reasons to take it. So I'm going to put this thing on. I'm going to be buying the 164s. I'm going to pay $4.70 a contract. You know, the 165s, you're not getting that much more off. 168s, it's getting a little bit too far out, right? Our first target is 168. So, yeah, Murat, that is kind of a pain in the ass. He said he likes futures too, but the margin call shit is awful. That's right. That's why I like holding the options. Okay, so let's just say we're going to play the 165s. If this thing makes a quick move up to 169, we're going to make more money on the position than just the intrinsic value up at 169, right? Because if this thing is trading at 4.25, that means we need this thing to be over 169 to be making money. But right now, a quick move up will establish a pretty nice profit on that. And we're probably going to have to roll and mess with this position going forward. If you don't like the idea of messing with it, what you can do is you can buy yourself a longer dated position. I'm actually going to put on the June right now because I want to mess around with this on the short term. I'm more of a trader, bro. And this is how I would play this. So I'm going to buy 10 contracts. I'm going to buy 5 contracts because we're trying to keep our size at about 1% per position. So we've got a $200,000 trading account on this paper account. So 1% is $2,000. So let's just do that. 165s. The spread is 430 to 435. I mean, this is a great spread. You can get filled wherever you like. You want to buy the bid, you can buy the bid. I'm going to go for the ask because this is a paper trading account. So confirm. I'm spending $2,100 for the 165s. So send. I now have that. So I've got some exposure on the GLD. Does it make sense to try to sell some weeklies? I mean, the other thing I could do in addition to that is buy the GLD itself. That's another thing is I can go ahead and buy 100 shares or so, but that'll pretty much make things difficult for us with a $2,000 position per 1% position per thing here. So maybe I won't be doing that. But anyway, let's investigate the September. I mean, I assume the 165s are going to be more expensive. Yeah, these are 880. The other thing is we could do spreads here to try to capture that into June. So let's see what a spread trade would look like if we bought the 165s and then we sold, say, the 172s, right? 172 is kind of into the profit-taking objective, but on the short term, at least we have a way of reducing the cost of this in the short term. So I kind of like the idea of that. We're going to buy the 165s and we're going to sell the 172 calls, which would almost cut this whole cost in half. So let's see what that looks like. We're going to buy a vertical here, and we're going to sell the 172s. And this gives us a month. That may be too much, but again, we can play with this into next week. So we're going to do 10 of those because we bought 5. So this will still be around $2,200, and therefore that reduces the cost of this position. I guess I can put this on as well just to track it. This isn't how I personally would want to play it. I just kind of like having the upside now. I think that this thing has broken out and it makes sense to be buying it. If you're uncomfortable, this is the way of playing it as well. Oh shit, did I just mess with this? Oh, this is going to combine my positions. Ah, shit. I should have known that. Oh, well, it's hard to do that. So we've got more upside exposure than we do to reduce the cost here. That's fine. We'll just leave that as is. Yeah, the DOM. Okay, so that's how I play the GLD for now. It's not the fanciest and probably enough to capture some upside going forward here. I like it. Maybe we'll start to close out some of the position as we get to that 168. We'll figure that out next week as we go forward. But right now, I like to have some upside positioning. All right, those are the positions for now. We got one new trade. We reviewed the old ones. What do you say we move on to crypto, Jamie? Is there anything else you want to chime in here?
No, that's it, to be honest. Sounds all good. Gold-wise, yeah, all good. Shall we move on to, crypto?
Okay. What do you
Sure.
cool to...
No, in terms of stocks, I haven't got anything to show, to be honest. I've probably got about 25 on a watch list, but until they get to the levels that I'm happy with, there's no comment as of yet. I've been looking at a couple of British REITs that have really got punished. Nibbled on a couple of those, but that's about it, to be honest. So yeah, let's do crypto.
All right, should we move? Let's do some crypto news. Yeah, I know it's sad. We don't have to get upset about it. All right, first things first here. We've got an interesting article that talks about the demographics, or not the demographics, but the participants on Coinbase and the way that they behave. So it seems like 40% first-time purchases on Coinbase are not Bitcoin. They're actually altcoins. And only 24% of those investors seem to be first-time Bitcoin purchasers. And then 36% of them end up, so a third of them end up buying other assets, which is an interesting conversion rate. You don't actually get that with advertising usually. So the other thing that's interesting is that relative to market cap, some of these other coins like Tezos, Link, and Bitcoin Cash, and even Litecoin, they're trading more than their market caps would suggest. Meanwhile, Bitcoin is lower in trading volume as compared to its market cap. And then you've got these fancy market cap dominance charts. You can see that the altcoins seem to be heading up, whereas Bitcoin dominance is also on its way up. It just depends on the time frame you look at it. This is a daily, but long term, there's no doubt that the dominance is, these are both weekly, sorry. These are both on their way up, and Bitcoin seems to have captured a short-term bottom here in terms of dominance. And the interesting thing about all this is people are participating in those altcoins, and they still believe in them, which is why we see some of them running. Next article here is about the Bitcoin hash rate. It seems like since halvening, the hash rate has gone down by 36%. And I decided it'd be interesting to see if I could overlay the Bitcoin price with the hash rate on a trading view chart. And I was able to do that. Where is this? Here we go. So the white and green lines are the hash rate, and the candlesticks are the Bitcoin price. Hey, it looks like the hash rate has definitely come down. Can you use this as a reliable method to understand the direction of price? I don't think so, but it is interesting to note that the hash rate has broken down. And the last time that it did that, actually the last time the hash rate broke to the upside, it seemed like it was delayed, right? Price went up, hash rate broke out, and then it dipped. And then you see the hash rate come back down after the price dropped. And that's just a function of the way that the miners work. Maybe they decided to pump up the processing so that they could move some of their Bitcoin. Maybe they wanted to acquire more Bitcoin into a buy the rumor, sell the news event, which this might be. It's interesting to overlay it. I don't know if there's any more lip service we can give to that. So we can move on to the next article, which is about, I don't even know if this is worthwhile, but basically you've got Craig Wright talking about Bitcoin Cash and his court case with the Kleinman estate. Is this going to make Bitcoin Cash suffer over time? I don't know, but he keeps making shit up, and evidently he turned in some false Bitcoin addresses, and the court or some people caught him doing that, and he might be in trouble. That's always a freaking saga with him. The other interesting thing that happened this week was Reddit introduced an ERC20 token for people to participate in, which if anyone makes some quality posts and gets karma on Reddit, they generally are familiar with that karma system, but now they've moved to giving people ERC20 tokens called Moon tokens. 20 million people use Reddit, so now you may have a completely new user base who are interested in cryptocurrency. I don't know if I would make that leap. I just thought it was interesting that they're putting this on the Ethereum chain. So that's your news. Halvening happened. It was a non-event. I mean, more like a sell at the event. But what I do want to talk about is I started on Sunday putting together a text document with my thoughts on what I think was going to happen throughout the week with Bitcoin. I'll start off with this. The daily, I said that the bear internals looked like they were prevailing, but no price action to speak of. when I pumped this out, that was on the 10th. So we were looking down here after price had come off. And I said that I was looking to play a short near the top of the range from 9,700 to 10,000. And sure enough, yesterday and today, we come right into that 97,000. In fact, the high yesterday was 99.43. I thought that, we had the potential to pop above the top here and then sell off. So the fact that we haven't doesn't necessarily mean one thing or the other. It just makes it a little less difficult to trade, right? Those FU moves where they pop people's stops and then dump off. I mean, that makes it really hard to trade. But that didn't happen the last time here either. This is on Coinbase. This was back in February when we sold off. Really nice, consistent lower highs. We have one lower high here. I think there's still some more work to be done. And I also don't think that we are in the environment necessary for a sharp dump a sharp dump to the downside. If you take a look at the moving averages, they're still very much apart. Now that could change into next week as this thing dumps down into the 8,500 level and stays there. But one cannot ignore the simple fact that this 200 period moving average is now the 30 and the 13 moving average have now crossed bullishly over the 200. That is a very bullish sign. But generally, the price will have to recheck that crossover. So I'm looking for at least something coming down into, and maybe we don't get to 38.2, which is fine. This 23.6 level is something that I've been watching for a while. This is what happens when things are still bullish. I mean, like 38.2, that's your real first stop. Is it a bull? Is it a bear? How do we resolve from there? I mean, look, we bounced into that 23.6 and then we came back up. Now we're toying around with this level. This could just end up being a sideways consolidation that recharges itself for the next move higher. I think that's certainly something that could be in the cards. So if you're a daily trader, there's really nothing you can do here in the short term because those bear internals, I mean, they're pretty much played out on the MACD here. You got that bear div, it came in, we got that slight dump, but then we recovered. I don't think there's a good trade on the table as much as I did on Sunday. I think that this is going to be a sideways trade. Now, I also said on that document there was no trade on the 4-hour. Well, I don't think I've really changed that conviction. Nothing's really developed here other than a nice 4-hour double bottom, which broke and retested the original breakdown area from last week. So we're kind of caught in the middle of two support and resistance areas. And I think it's pretty easy to just draw some lines. And, if we break above one area, then you have to start thinking about going long. I don't think you buy the breakout. I don't think it's going to be that easy. I think that maybe you get a pop and then the market fakes people out and then starts squeezing them. I think that's also possible. Maybe you get something like this and then we come back down and retest the bottom end of this range. Weekend trading's coming up. That's always a bit wonky. I'd really like us to come back down into this area. I don't think we're going to get that, though. I think we kind of just mess around between here. Now, the other possibility is that we break below that level. And I think if we do, you're going to have to be really quick on your toes because that would mean the daily is where the trade is at. And if you take a look at where that breakdown is, that's right at the neckline of what this potential market structure breakdown would be. And I think you would have to fire it off pretty quickly because that breakdown would tag 7,700. So you're talking almost $1,500 to the downside, $1,700 to the downside in relatively quick order. I don't think that's going to happen right away. I think we're going to get some more signs. I think tomorrow, if we get another inside bar to the downside, something along the lines of, where's my brush tool? Get a nice red color, just one nice red candle like this. Then you can start to imagine that the continuation to the downside is there. But my conviction is that we're still going sideways to up. So I wouldn't be putting a short position on right here. Now, with that being said, let's move to Ethereum and what I published on that. where's this window? So Ethereum trading, I was really interested in oh, I forgot to cover what I saw in the hourly, which the bull internals were playing out without a breakout. I said I was looking for a fib test at 82.40 to 83.75 to go long into that zone. I didn't actually take that trade. In fact, I took the trade on Ethereum. You guys know me. I like to play that Ethereum market much better. So on the 10th, we're back down here. You can see that we did end up selling down into about 8,400 on Sunday evening, late or early into Monday morning. We didn't get quite into that range, but the next day we did. And then going long into that was perfectly fine. I took the trade on Ethereum going long because that ended up going into the level that I wanted, and I sold into the same similar candle that we had on Bitcoin here. So let's go and take a look at that hourly trade that I had tweeted out here. So same thing on Ethereum. I said daily bearish double top, bear internals, looking to play a short from 199 to 200. If we take a look at Ethereum, it actually looks a lot worse than Bitcoin does. Here you can see bull internals playing out without breakout. I was looking for a fib test on the low end at that 184 to get long for a bull bounce to screw over anyone who had gone short into the weekend, and we got that. So taking a look at Sunday, well, what time did I tweet this thing out? I'm actually interested to just see when this came out. So I tweeted this, what, May 10th? Is this going to give me a time here or no? Probably. Oh, here we go. 9:51 p.m. on May 10th. Let's bring up our Ethereum chart. May 10th, 9:51. So I tweeted this around here, and 9:51. So this is the candle that I was looking at. I was expecting that retrace to the downside. Why don't I have these fibs on here? I must have deleted them. But anyway, you can see what I was thinking is that I went from the lows here to the highs here, and we went all the way down into that level. So if you bought this dip here in between those two areas, you had a nice position just for 12 hours, it seems, right? Because if you bought 184, and granted, this thing still continued to go down. So you took a little bit of heat to the downside. You buy that 184, and then this thing recovered, retested it again, so you could ostensibly have moved your stop. Maybe you've gotten stopped out, maybe not, maybe you put it lower down into that area. I bought the 182.5 area, or sorry, 183.5 area. That was just between 61.8 and 78.6. I had my stop at new lows, which is really what you should be doing when it comes to these kinds of trades. I don't like getting stopped out on FU moves. So the low here was 180.40. My stop was 179.9. So I usually take a position knowing that my stop loss will make me lose a maximum of 20% on the position and then go forward from there. So I bought that, didn't hit my stop luckily, and then I actually didn't have a chance to readjust because this happened in the overnight hours. You know, by 11, 12, 1 o'clock in the morning, we had already bounced, and then 6 a.m. this thing's coming back down into that New York Hill Zone, popping up into that 195 area, and I actually set my profit objective at 192. So I got closed out here at 38.2 on the retrace to the upside, booked a nice profit. And it's a good thing because this thing ended up dumping all the way back down and making new lows. So I would have gotten stopped out if I held the position thinking we were going all the way up. So, be careful when you're reading when I'm publishing on the daily versus the 4 hour versus the hour. There's totally different stuff going on there. And depending on how much people enjoy this, I'm happy to continue updating specifically what I'm thinking about each day and how I'm trading it. That's something I want to offer going forward. So anyway, this thing did quite nicely. It was a nice trade on Monday, but now what I was looking at was the daily. I was looking for this thing to stall out in the 201 area. This thing kind of popped a little bit higher than that. We ended up going to 206. I still ended up taking the short at 202. So I've been short since yesterday at 202. I'm sitting right now in the position. I'm a little, the internals look very similar to Bitcoin. The price structure looks similar to Bitcoin. I can't see Ethereum dumping to the levels that I'd want it to dump on Bitcoin as well. I think this thing may end up going sideways just the same as BTC here. But nonetheless, I do have that short position on. Where am I looking to close this thing out? It's quite simple. I'm just going to take the high and the low fib, and I'm just going to trade this like it was a trading range. I'm going to take this thing off at about 188. So I'll book about $15 worth of profit percent wise. It's going to be a decent return. I'm trading at 5x leverage. I think it's still a decent position to take. These moving averages here look similar to Bitcoin again. They haven't crossed bearishly. Take a look at the 4 hours, see if we can get any other signs that are different than Bitcoin. It looks almost like a market structure top. The internals do not look bearish. I mean, I may have too much of an optimistic target at that 188 area. The other thing that I may do is I can close out half the position at 195, which is that 38.2 level. And what I would do is I would move my stop to the highs of this 4 hour candle and also this 13 period moving average in red, which would be 198. So I would actually move my stop once we hit 195 to about 199. And if I get stopped out, I still have a profit. I made money on that 38.2 tag. And then I can at least reposition myself going into Monday, Tuesday, because again, weekend trading is fun, but you have to be at the edge of your seat playing this thing on the lower time frames. I'm talking 1 hour, 30 minutes, and even 15 minutes. Those are the 3 time frames that I watch on the lower time frame. So if you're bored this weekend, it's rainy near you, you don't have anything to do, maybe this is what you do. It's not going to be rainy for me. I'm going to do a little outdoor picnicking in the park, so I won't be around trading this thing this weekend other than managing the position as I just talked about. I don't think we have enough time to talk about any of the altcoins. Those seem strong. I would have expected a lot more of a pullback in many of those, although with the exception of the ZRX, which we were trying to understand why did this thing pop so much last week. Holy shit, this thing just popped again. That's incredible. Is this right? It was trading at 0.34 when I last looked at it. Why is this saying 0.41? So the low here was, oh yeah, it went from 0.3. I mean, look, these things are popping off. There's a lot of interesting opportunities to have in this market. I don't like this one. I think this is a pump and dump scheme. There's no real money that can keep this thing honest when it comes to leverage positioning and other products that could keep this from being pumped and dumped. And that's why it's an easy target to be messed with. EOS, your usual Tezos, things like that. I kind of like the way these things are looking. I don't have any new positions that I've taken other than I just freed up a whole bunch of cash when I sold my ZRX position, but I sold it at like 0.39. So I'm kind of pissed, but whatever. It's gone. I've got a bunch of cash that I'm looking to put to work. I don't think I'm going to be buying much because everything seems like it's trying to resolve the halvening event, and there may be better opportunities going into next week. But we'll probably let's reserve that for next week. Jamie, is there anything crypto-wise you want to chime in on? Otherwise, I think we might be able to call this quits at 1 hour and 20 minutes, 1 hour and 12.
I think an hour, easy, mate, easy, no problem. Yeah, I mean, a few comments really. I mean, talking about Reddit and them creating ERC tokens. I mean, it'd be great if there was a little bit more structure with some of these coins, so then we can actually so we can at least go long term, a little bit more investing rather than just shit coins going up and down. It'd be great if they had like quarterly releases of what's going on and knowing the amount of subscribers, for example, the Brave browser, how many people they've got and things like that. That would be pretty cool, to be fair. But yeah, in terms of Bitcoin, I mean, I don't know if I'm actually sharing or not.
Oh, let me switch to, yeah.
But yeah, I mean, in terms of Bitcoin in general, obviously bullish standards. I don't bother trading anything anymore. I mean, I don't really need to. Yeah, I've had my fun with crypto over the last Jesus, how many years has it been now? Like 7 years. So in all seriousness, I just concentrate on the equity markets, and then if I do trade anything that's Bitcoin specific. I usually have some investments in the I trade sometimes some of the mining stocks, but I think as like a medium to long term trend, I think it's important to have a look at the MA. So I mean, again, as we did like with equities, looking at like the 50 EMA and MA and the 200. Like you were saying, I mean, at the moment, as you can see here, you've got your long term downtrend, let's say resistance levels that you've had now for a while. I mean, if I zoom in and go on the daily instead, we can see, whether we go higher from here, again, as Thomas says, over the weekend, it's a little bit crazy. But in terms of whether to be a buyer or seller, I mean, I'm starting to get people now asking me, asking me about Bitcoin. Should I buy? Should I buy? And honestly, I mean, I'm always saying just be patient. I mean, okay, yeah, it's gone up now. It's gone up a lot. But I'd much prefer to not bother telling my friends or people who I know or people who are asking me to buy. It's just being patient at this point. And it's not necessarily being bearish on Bitcoin, but it's to do predominantly because of the uncertainty of how cryptocurrency behaves during a recession. I mean, we can't forget that it's the first time that crypto is going through a recession. And I mean, looking at how it's performed, as you can see here in Feb, March, it did correlate with the S&P and still is highly, moderately to highly correlated with the S&P that I did speak about over the last few weeks. Thursday, it seemed to have decoupled randomly. Whether we start to get more frequent things of that, I'm not too sure. But today does still, again, seem to be correlated with the S&P. So the way I'm looking at it is that I think wouldn't surprise me if we go down and test where the 200 MA is, and also to make double check that green line that we have here just going from resistance and definitely becoming support. And then again, it depends on the markets. I mean, if we do, like everyone wants, say, a leg down in the markets, if everything still is highly correlated if that happens, then personally, we can't be surprised to see BTC going down, even to test down to 5,300 levels. People are going to hate me in saying that, but I think it's entirely plausible. I mean, if we're talking about, this isn't the end of legs down in the equity markets. Well, if you've got a correlation still, if BTC is still moderately correlated with the S&P, I'm sorry, but you've got it's going to go down. So I'm on the fence in terms of whether we go up or down from here. Like you say, it's difficult. We could just trade sideways, whatever. But I suppose I'm a long-term hodler, so I'm not really too bothered as long as I've got my Trezor around my neck, or is it Ledger on my neck? Then it's all good. But I just think that with people saying, "Oh yeah, we're going to the moon" and all of that. Yeah, long term, I completely agree. I mean, how can you disagree? But in the medium term, until we start seeing it decouple from the markets, and the markets actually finishing with everything going on with the virus and the recession, that will go on for a while. I'm still dubious to say that we're just going to go up and up and up from here. So I mean, that's my view. Really, with BTC, I don't bother looking at shitcoins like Ethereum, so I don't really get into it. But no, that's about it from me, mate. That's about it. Yeah. So
great. I think that's a great point to remember, is that if the broader market does sell off, that crypto will not be insulated from that kind of that risk. So that's definitely a great point to bring up. But yeah, look at us. We finished in less than an hour and a half.
I kind of love it, to be honest. It's nice and condensed, quick, just getting on with it. I mean, next week will probably be different because, I mean, as long as the deliveries are still good, the whiskey should arrive. So yeah, exactly, man. Oh dear.
All right. Well, yeah. I think that's all for us. We covered everything we wanted to. I think we did a pretty good job today. We're going to make some adjustments to the equity trades next week. And I guess look for me to put out something about my expectations from crypto on Sunday night. I'll try to tweet that out. It may just end up being gotta wait till Monday. I have a feeling that this is going to be either a very sidewaysy weekend, but I'm happy to be disappointed, and maybe we get a break higher. or break lower. You know, it could go up, it could go down, it could go sideways. Great. Thanks a lot, Thomas. You're really useful. Anyway, let's call it quits. Thanks for joining us. This is a great time. Jamie, I hope you had a great birthday yesterday. I know you were pissed that I tweeted that out, but you know what? Happy birthday to you.
Cheers, man.
I hope you have a great weekend, and I hope everyone else does too. Thanks for tuning in, and we'll talk to you next week.
Yeah, take care, guys.
All right, and end show.